Execution only. It's a troublesome subject for compliance practitioners. Financial services firms like to argue that they didn't give advice and therefore they cannot be responsible for the damage that a customer taking a certain course of action has suffered. But it's a difficult argument and it causes all kinds of risks to firms that they frankly would be better off not running. I first really encountered this argument in the late 1990s. The pension review was in full swing. That involved firms looking at millions of transactions in which people had been advised, and frankly they were, to transfer out of final salary pension schemes or opt out of employer pension arrangements or not join them and put money into a personal pension somewhere else, which should frankly have gone into meeting the minimum contribution of an employer's pension scheme. The regulator took a very dim view of firms that rejected lots of cases saying that they were execution only. They got pretty suspicious fairly early on and required in the pension review guidance that firms supply a confirmation by the customer in writing, signed by the customer, as it eventually turned into when they moved on to the FSAVC review, a sort of supplementary project that happened later, that confirmed that the customer neither expected nor received advice. Now, that was not actually a requirement of the rule book when the relevant transactions took place. The reason for this extra requirement was, frankly, the high volume of execution-only cases that simply didn't make sense. People don't actually do their own pension transfer without seeking advice. The transaction is too complicated and too fiddly. And anybody who does such a transaction is likely themselves to be something of an investment professional. This is not the sort of thing that ordinary members of the public go in for. We've seen this in more recent times. In a case called Rubinstein and HSBC, it was argued by the bank that Mr. Rubinstein had put his money into an AIG enhanced fund investment in a bond without receiving any advice from the bank. The judge sat and listened to the evidence and went, I don't think so. I think I might have been involved in a supplementary case of this subject in a case called Van Geens against Yiska Bank in Gibraltar, where I prepared a detailed expert report on how implausible it would have been for the bank not to have recommended another extremely complicated transaction, perhaps more complex than all the other ones put together, frankly. In fact, as I was about to walk into the witness box, counsel for the bank immediately said, I'm not going to be arguing that this was a non-advised or execution-only transaction, which kind of made a mess of the first 10 pages of my expert report, which were dedicated to the inherent implausibility of such an argument being true. Now, there are plenty of areas where people don't get advice. Notably, when you go to the supermarket and you choose your packet of cereal, you're not seeking advice from the staff dotted around your friendly supermarket. And the same is true in financial services transactions for execution-only share broking services, where it's very obvious you contact the firm because you want to buy or sell a share without receiving advice. And there is nothing more to it than that. This transaction and the service is labeled very, very clearly. There is no need, as there was in the pension review, for a letter from the customer to somehow prove that they did not expect or receive advice. That distinction, by the way, is interesting. The original definition of execution only had the two elements, expecting and receiving advice. In practice, they tended to get merged. If a firm did give advice and the customer acted upon it, then obviously the firm was liable. If the customer expected advice but didn't get it, there was an interesting argument that suggested that the firm's completion of the transaction represented their way of saying, I think it's a good idea. And it certainly makes a certain amount of sense in the pension context. However, if you're buying motor insurance from a firm that does not offer advice, as just a product provider, then it's perfectly plausible that you do not receive advice, and that's just fine. It's usually not the case, however, that when you go to a financial advisor, what you get is an execution-only transaction. The financial advisor's function is to advise. I was actually many years ago involved in a slightly bizarre execution-only case involving an independent financial advisor, where the advisor correctly won a case at the Ombudsman, although only after a hearing. In that situation, the firm noticed that the application form had another firm's number scrubbed out on it. What probably happened was that the customer did receive advice, but not from the firm that put the transaction through the books. It's a very, very rare example. In fact, the Financial Ombudsman Service, in an Ombudsman News many years ago, pointed out the general implausibility of people who are not financially sophisticated doing non-advised transactions. This was a case which was quite awkward from that point of view, because I'm not sure the customer was that sophisticated. However, I do think advice had been received, but not by the firm that put the transaction through the books and was being blamed for the losses caused. A common mistake is made by modern financial services firms who write a lovely annual review letter pointing out that the ISA allowance should be used at the start of the new tax year, and then think that they are somehow doing an execution-only transaction when they put together an ISA proposition that happens to match that recommendation. The earlier piece of advice prevents the subsequent transaction ever being execution only, at least as regards the use of the ISA allowance. And frankly, when having recommended to the customer that they use that allowance, the firm then presents some fund holdings in a product provider, it doesn't half look like a piece of advice to me. I think to call that an execution-only transaction is for the firm to mislead not only the customer, but itself. It shouldn't be done. Finally, even if the transaction is execution only, there are two more problems. One is obviously to make sure that no advice actually was given. So if you are running a non-advised service, you need to check your telephone lines and records to see whether or not advisors are making recommendations when they're not supposed to be. And the second problem is that you still, as a firm, have to be clear, fair, and not misleading. There are lots of examples of firms cheating on this one. In the pension review, the classic situation was the firm that circled the higher growth rate that would be achieved by transferring a pension to a personal pension. The whole point of the three growth rates was to give a balanced view of what could be achieved. That was clearly misleading. Similarly, where marketing material just simply doesn't pass the standard financial promotions tests, it's quite likely to fail clear, fair, and not misleading, and the damages claim follows from that rather than any advice that was given. One last word should be about staff sales. You used to get in the pension review, you don't see so much of this now, sales teams being heavily incentivized to achieve certain levels of transactions. And when teams were a little bit short of their targets, individuals were encouraged to do transactions relating to their own finances to bring the sales target within reach. In that situation, it's a simple advised transaction. If you think about it, you know, come on, Johnny, if you were to only transfer your pension to our firm, then we'd meet the target. The other way of looking at it is that where there is mass mis-selling, and I'm not talking about one-off cases, where a staff member has done something to themselves that is definitely not in their best interests, then it should be seen as an advised sale, because typically members of staff or members of a sales force or even members of a financial advice network are being advised to sell in this way. And the misleading advice, if you want to call it that, I'm not sure whether it's advice or just a breach of clear, fair and not misleading, is coming from the firm and is causing the loss. Either way, financial advisors advise they shouldn't have any execution-only transactions. There are non-advised functions or businesses. I can have no problem with them being execution-only transactions, the deals that they produce, although they should be checking their phone lines on a pretty regular basis to check to see that they're not giving advice. And also they should be concerned not to incentivize their staff to generate business, because there's always a danger if you do that. Someone will push someone into doing something, and that's not an execution-only transaction.